Alright, let's continue. How to get trading discipline. And before we start, let's watch the traditional disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial, and you will have full responsibility for any of your trading decisions. Past performance is not a guarantee of future returns. And the first question that I want to pay attention to is, do you have an edge? When traders sometimes ask me how to develop discipline, the first question that I ask them is, do you have an edge? We have a special webinar on this topic that is available on YouTube Exness channel. It is named The Trader's Edge, how to develop a successful trading strategy, or how to win a trading marathon, or something like that. Alright, so do you have an edge? First, make sure that you have a trading edge, that you have a statistical edge, that you have a successful trading system or a method that you believe in. And if your method can't make you money, if your method cannot respond to changing market conditions, if your method has no expected value, discipline won't help you. Too many times traders think that their problems lie in the psychological field, which is not necessarily so. So first, I would suggest that you test and evaluate your strategy. And we have many webinars on this topic. For example, the non-random way to trade part 1, the non-random way to trade part 2, how to trade breakouts, and other topics that might help you in this endeavor. All right. So, do you have an edge? Well, for example, I have met a trader once who were risking too much, and he was trying to fix his psychological issues. I have asked him, what is your risk? And he answered that his risk is 10% for a single position, 10% of the account for the single position. Well, that was absolutely insane. And he has negative or losing maths beyond his trading, and that's why he could not make any money. He could not generate any profit, and discipline will not help him. Because if he was disciplined in trading such a plan, well, 5 losses and he's out of the market. Well, that's why I first want to make sure that trader has an edge when I work with traders. Alright, the second thing that I want to know is whether trader is committed to his trading style. Too many times we take someone else's strategies, trying to figure out how the market works, or trying to earn more, because we hear from time to time that scalping is very profitable, or position trading is very profitable, or I don't know, maybe options trading is very profitable. We hear it from many places, from many traders, and we might gravitate to one strategy or to another strategy, but if it is not the strategy that is good or that fits our personal strengths and our lifestyle, we will not be able to follow this strategy for a long period of time. And the first thing is commitment. And to be committed to your trading, first you have to know that you have enough free time to follow the market. That is number one. Well, too many traders try to day trade, but to successfully day trade, you have to be in the market. You have to be near the monitor during the most active hours of the trading session. Not too many traders have this time. Even if you have this time, you might not be a very active trader. Well, it might not be a personal strength. You might not process information that quickly that is required for active day trading. And some traders spend 2 or 3 years discovering different trading styles, or wanting to know whether one trading style is good for them or not. Well, I would recommend you to keep a journal, to listen to yourself, to listen to your feelings, to listen to your response, even to your body language. Make sure that your trading style fits your personal strength and your lifestyle. Number 2, you don't feel bored and get enough stimulus. For example, some traders think that if they make one trade a month, it would be sufficient for generating profit. Of course, there are There are strategies that generate pretty rare trades. For example, position trading. You can have no more than one trade a month. Even if you have 10 or 15 trading instruments, you can have no more than one trade a month. For many traders, for many active traders, stimulus is not enough. When they follow the market and they are not in the market, they feel bored and they lose commitment. So you have to find the exact point where where the activeness of a trading strategy and your personal strength come together, when you get enough stimulus. I don't know, maybe you're a scalper, I don't know, maybe you can make 50 trades a day. Well, I know such traders that make 50 trades a day and still they are successful. They don't make much money, very much money, but they earn money and they're profitable after all. And the third one, you are interested in the process, not in financial result. If you have these 3 points, you will have commitment. If you have commitment to your trading style, well, we can talk about discipline, because when you are committed to a trading style, you will have what it takes. You will spend enough time to execute upon your strategy, and after that you can work on your emotional issues, on your execution. You can work on emotional issues because they will inevitably appear in your trading. So 3 points: enough time or enough capital maybe to follow the market, to follow the strategy. You're not feeling bored and get enough stimulus from your trading. Trading is interesting to you and you are interested in a process, not in financial result. There have been times in my career as a trader when I was not able to make any trades. I didn't have account. I was just paper trading, making trades on a demo account or just observing the market without being involved, without risking money on the market. Well, trading was still interesting for me, and that's why it was sort of a test. I have identified that I'm a trader because I'm interested in the process, not in financial result. And after that, financial results also come by. All right, let's proceed. Let's talk about disciplined trader. Who is disciplined trader in my opinion? First, to be a disciplined trader, you have to have 4 key points. The first is knowing your emotional pain threshold. What do I mean by emotional pain threshold? For example, when you risk too much, when you lose too much money, when you are unprepared to lose that amount of money, you can cross your emotional pain threshold. Not too many traders think about that. They think that, all right, I can trade on $1,000 account, and I can afford losing, I don't know, $30 or $40 on a trade on a single stop loss. So things would be the same with the account of $50,000. But when they start to trade larger account, they can lose, for example, I don't know, they can lose $1,500 in a single trade, and they cross the emotional pain threshold because they see these numbers, and they are absolutely unprepared to see such loss on their account. So they cross the emotional pain threshold, and that's the first thing. The second thing is that when you lose maybe not too much money but too frequently, it is also the danger of crossing your emotional pain threshold. For some traders, a series of 5 losses is absolutely stressful, is absolutely frustrating. For another trader, it is okay to get a series of 10 losses. For example, in early days of my career, I was very uncomfortable with losing more than 3 to 4 getting 3 to 4 losses in a row. And that's why position trading, long-term position trading was not good for me, because in position trading I have to earn on relatively smaller number of events. I have, I don't know, 80% of losses, small losses of course, and 20% of profits, and that's why I was unable to trade with position position trading strategy. For now, I'm okay with small losses and with series of small losses. My emotional pain threshold has become more robust, more solid, and other strategies or different strategies are available to me for right now. All right, the second is commitment to the process. We were talking about this so far. And the third is observer state of mind. What is observer state of mind? We have to cultivate observer state of mind because it is a state of mind where we can, from this state of mind, we can really obtain self-control. Our view on the market will be broad, not narrow, and we will be able to make alternatives, to make actions not in automatic mode, but we will be flexible. And the fourth point is flexibility. We have alternate ways of response. It is really flexibility. You might ask me how flexibility connects with discipline, and I will answer that flexibility is the ability to switch between different ideas. When you search for trading ideas, when you analyze the market, you have to have flexibility. But when you are in position, you have to have rigidness. So you turn to risk manager from analyst, or from even a trader. You turn to risk manager. You simply manage your position. So flexibility is the quality, or is a characteristic that is good for the period of preparation, for the period of analysis. All right, so 4 key points. Now let's talk about emotional pain threshold, about the point number 1. Well, when intensity of stress increases substantially, for example, we lose very much money in one trade or in one day, and our emotional pain threshold is crossed, we are losing self-control. We are losing self-control, and we are losing connection between our actions and our personal strengths. Well, I don't know whether you are familiar or not with trading systems that require no stop losses. For example, martingale, expert advisors, or so. They earn small amounts of money. Very frequently, they might have 95% rate of success. They earn very small amounts of money, but someday they lose, I don't know, 30% of the capital because market goes mad. Volatility increases substantially. For example, Fed comes with an announcement, or any other central bank, and such traders experience really big losses in a single day. And that's why they continue to average losses. They continue to buy even more and more and more. Market goes down, they continue to buy more and more and more. And they can't control themselves, and the intensity of stress is very big. That's why such kind of strategies with very big frequency of winning trades and very big magnitude of losing trades, they are very dangerous. They are very dangerous. That's why I avoid any martingale-based strategies, and I recommend to avoid any martingale-based strategies to all traders. All right, so intensity of stress. When we are crossing our emotional pain threshold, we are no longer able to sustain connection between our actions and personal strengths. All right, very good question. We will talk about it a little bit later, okay? So of course we will have tools how to work on this stress. We have tools. All right, for example, we have patience as our personal strength, right? Or we are good at recognizing patterns, or we are good at rapid thinking and reacting. We for example, are good scalpers, or we are making good research and analysis. When we cross our emotional pain threshold, we lose our connection. We lose connection between our actions and personal strengths. For example, we start being impatient if we had patience before, and we fail at recognizing patterns. We find really bad trades. We find really average and mediocre trades, and our analysis starts to be very mediocre or very bad in some cases. If we have been scalpers, we start overreacting, over trading, and doing more and more trades that we were not expected to do. Or on the other hand, we start trading defensively. We avoid risk. For example, if we have to trade frequently, in these cases we might freeze and avoid trading. That is a danger of crossing emotional pain threshold. But what if we are already in a drawdown inside a trading tilt? I called it the position inside a trading tilt. The first phase that we are dealing with is denial. All problems, all issues with discipline start from denial. When we have a losing trade, when we move our stop loss, it is denial. We cannot fix the loss because we are not fixing the loss. We are fixing our negative emotional state. It is very important to understand. We are not fixing a loss, and we are not fixing a profit. When we trade in emotional state of mind, we are not fixing a profit. We are fixing our pleasant feelings. And we are not fixing a loss, we are fixing our negative feelings. And that's why we avoid doing that. We deny that. But when our position becomes even more and more, loses more and more money, we start feeling anger. Right? Anger on the market. We say, all right, I will fight the market. It's not going to capture my money. No way, I will sit in my position. I will not let it get my money. All right, it will get back inevitably, and I will get it all back. I don't know, guys, whether you're familiar with those states of mind, but they are familiar with every trade is familiar with those states of mind, because I don't know, maybe you are new to the markets, or maybe you're experienced traders. If you're experienced traders, you know that stuff. All right, you are feeling anger. The third one is bargaining. We start bargaining the market. All right, please market, come back to our entry point. I will not execute such trade. No way in the future. We start asking the market to come back, and we experience hope. The feeling in this phase, the phase number 3, is hope. We hope that the market will get back. We are waiting for weekends, because market is not trading in weekends, and we are not losing money at weekends. And finally, we are coming to the phase of depression, when we understand that the market will never come back, and we have lost a lot of money. When we have lost a very big amount of money from our account, we fall into depression, in the depression phase. Depression phase is a really uncomfortable and unpleasant phase, because we feel helplessness. We can't do anything to help our position. We cannot influence the market, right? And the number 5 is humility. When we accept the loss, we take a rest, and we get rid of our position. So that is a 5-step process: denial, anger, bargaining, depression, and humility. So the first thing that we have to know is that we have to avoid the phase number 1, denial. It is very important to avoid denial. Honesty is very important in trading. Why do we keep a journal? Because we want to be honest with ourselves. We want to know whether we are experiencing or feeling anxiety now, or we are afraid of losing money now, or we don't want to fix our negative emotional state. So we have to very quickly recognize what is happening to us. It is called self-awareness. The self-awareness is possibly the number 1 characteristic for a trader, because if we are self-aware, if we have emotional intelligence, If we know very quickly what's happening with us, we will not deny, and we will not make our position lose much money. Sorry. All right. What if we are already in the phase of a drawdown? First thing to do is to halt our trading, to stop our trading, and to take rest from trading, or even withdraw our funds, because for some traders it is not enough to take a rest, to take a 2 or 3 days of rest. I know one trader who had lost very large amount of money previous year. He had lost around several, I don't know, it was around 40,000 euros. Well, pretty large amount of money. And I suggested that he could take a rest. He had taken a rest, and he was not trading for the period of 3 weeks. He came to the market after this 3 weeks of rest, and he had lost even more money, or I don't remember the exact amount, but it was pretty large amount of money. So his decision, or his solution, was to withdraw funds and to train his skills on a simulator. Well, secondly, we have to live through our painful experience. Before we live through our painful experience, we should not do anything. And what do I mean by living through our painful experience? So we stop our trading, then we start just journaling our thoughts, our I don't know, fixing our emotional states. We might do some exercises, we might do some physical activities. Well, in this phase, we should take a rest from the market and even not to look at the charts. And number 3, only after that, only after we stopped our trading and we have come to the phase of humility. You guessed that point number 2, living through painful experience, is a phase of humility, right? So we are coming to the phase of humility. It's the final phase of loss, final phase of the loss. Only after this 5th point we can get rid of our loss. We can come to the next level. We can make a trade in a fresh state of mind. Alright, only after that we can analyze and make conclusions. It's very difficult to analyze what is happening when you're inside of a trading tilt. When you experience losses, it is very, very difficult to make analysis and make conclusions. When you have come to the phase of humility, when you are okay with your losses, when you accepted the lessons that market has given you, now you can make analysis. Now you can make conclusions. Now you can capture important experience out of your tilt. Well, some traders never capture important experience out of losses, but I hope that you guys will do that, because it's very important. Well, really, nobody really learns on gains. Everybody learns on losses, and I will say to you that I have become very disciplined with risk management only after losing 2 accounts. The first account was lost in 2004. It was a pretty small account, not a big deal. It was around several hundreds of dollars, and the second account was several thousands of dollars. So it was larger account, and it was money that I could not afford to lose at that time. After losing the second account, after the entire losing of the second account, I said to myself, I will never ever let my account be lost. In other words, I will never let my drawdown achieve more than 30% of my account. I have learned the important lesson from this loss. All right. I hope that you will do it as well. But I'm not saying that you should lose money on the market. But if you will lose, you will have to capture important experience. All right. What is the problem and what is the solution for trading discipline? Traders too often think that performance depends on emotions, that they have to eliminate emotions. Everyone talks about emotions. Emotions. We have to eliminate emotions. We have to manage our emotions. But I will tell you that our performance depends on our actions, not on our emotions. We can be very emotional. We can even break keyboard. We can even, I don't know, we can even cry out loud. But if we do everything right, if we are not bringing these emotions to our trading, it is okay. And I will tell you a story about George Soros. You guys may know him as a large speculator who have been involved in the British pound crash in 1992. And everybody who were working with George Soros, they know that he was feeling the pain even physically. When his positions were losing money, he experienced pain in the back and other pains. He was not able to sleep, to have a good sleep. The pressure was enormous. Imagine that he was losing, I don't know, he was losing hundreds of millions of dollars in a single position. Of course, he was experiencing emotions, and other traders, they also are very emotional. Traders in professional proprietary trading firms, sometimes they can cry, they're very nervous, they can even break keyboards, but eventually they are good at doing the right things. They do right actions. Well, when you trade, I don't know, for several years, you are already not so emotional. But the key here is to do the right actions. To do the right actions. All right. So what does it mean that we do the right actions? When we experience any emotional state, too often we do automatic trading decisions. Our response is automatic. It is a response that is unconscious. We start fighting the market. We deny. We start fighting the market. We experience fear of missing out. We want to jump in a trade. We want to chase the market and many other destructive actions. I would say that those responses are automatic. We have those instincts, fight or fly, freeze, fight or fly. It is widely known proverb. When our ancestors were at the threat of some danger, they had to run away, and either run away or fight. So when we trade in the market, we might view our losses as a possible danger, as a potential danger. And so our fight or flight response turns on, and we start fighting the market. What does it mean, fighting the market? We start overtrading. It is a form of fighting the market. Or we start proving that we are right. When market goes down, we start buying more and more to prove that the market is wrong and we are right. So it is automatic response. What do we have to do? Actually, what do we have to do? We have to learn to halt and observe. We have to learn to choose our response. Not to be automatic. We have to learn to choose our response. It takes really, around 3 months to really develop a new habit, especially when we are talking about self-control and ability to choose our response. When we are living in automatic mode, I don't know, for entire life, I don't suggest that you are living in automatic mode, right? But many people, they are not even thinking about that. They're doing something automatically. When you drive a car, you just drive a car. You don't think about that, right? When you walk from your home to, I don't know, to the subway station, you don't think about that. You are doing it automatically. And many of the things that we do in the life, we do automatically. So it is in trading. When we come to trading, we start doing something automatically. But the market is very different from what we are familiar with. It is very different from any other field of our life, because it is probabilistic. It's probabilistic approach, probabilistic field of decision making. We are not so familiar with dealing with probabilities. Okay, so we know how to drive a car, we know how to work, we know how to communicate, socialize, but we don't know how to estimate the odds. We were not simply taught this in a school, I don't know, in the university. So we have to learn to do the first thing, to halt and observe. Well, it is approach that have come to us from cognitive psychology because we can, even work on our emotional states, and we might, want to know where from our emotional state uh, come uh, come from. So where our emotional state roots in our early childhood, I don't know. You can go to psychoanalysis and spend 3 years in the coach to discover where your emotional state has come from. But it is a very long process, and sometimes you don't have the time, you don't have the, I don't know. It is not a tool because you have to communicate with a psychotherapist. I would suggest you another way. The cognitive psychology is a better way in many cases because you are not dealing with the roots of your emotional state. You just learn the simple action. When you feel automatic response, you learn to stop, to get yourself back to the observer state of mind and to choose your response. It seems very simple, right? It looks very simple, but in reality, of course, it is absolutely not easy. It is absolutely not easy. And later on in this webinar, I will suggest you several exercises to do that, and several tools to learn to do that. First of all, the first tool is a journal of automatic thoughts. It is underestimated by many traders. They think that the journal is a trading log. You just put down the numbers, your entry point, your exit point, your loss or your gain. But also, when we keep a journal of automatic thoughts, we sort of anticipate our response. We get a step ahead before ourselves. We outsmart ourselves. What is a journal of automatic thoughts? We can fix our automatic thoughts in a journal because many thoughts are coming through our mind throughout the day, and we are not aware of those minds. We just don't pay much attention to those thoughts. Well, for example, what is an automatic thought? I knew that I would lose money here. That is excellent example of automatic thought. And in cognitive psychology or in cognitive finance, it is called hindsight bias. It leads to false conviction that you knew what to do, that you knew the outcome, but you lost money due to self-sabotage. It is absolutely false conviction. Why is it so? Because really you operate in circumstances with circumstances without predetermined, without prescribed result. You face uncertainty. We all face uncertainty. All traders. Nobody really knows what will happen. Nobody really will predict the market. Nobody can predict the market. All that we can do is to have the odds on our favor, stack the odds in our favor, right? All we have to do and all we can do is managing risk. Reward is not our responsibility. Reward is responsibility of the market. So if you feel, for example, that, or if you think, I know that I would lose money here, and you might notice that if you catch this thought, later on you might notice that this thought leads to the emotional state of shame, depression, anger, and disappointment, because you start thinking that, all right, you have made it. You have made it to self-sabotage yourself. You are not acting in your own best interest, and that's why you feel shame, you feel anger, you feel disappointment. You want to get it all back. An example, for example, when you buy at the top of the market, and market goes down, of course you see what has happened in the hindsight. You have seen that you have bought on the top of the market. You would say, all right, oh my God, I'm a loser. I knew that this would happen, but I have lost money. I have done to harm myself. But if you fix your automatic thoughts, you sort of eliminate your emotional state of shame, depression, anger, and disappointment that goes after this thought. Another example. When you feel that you know what will happen in the market, for example, breaking the A level opens a path to B level. All you have to do is just to fix this thought. And later on, you analyze your journal and you understand that after this thought, you started to experience anxiety, fear of missing out a trade, overconfidence. Because if you feel that market will go right now, you have to jump in this market. You have to catch this train. And of course, guess what trader will do in this case? He will double his position, double the size of his position possibly, or add to his position because he trades his conviction. He is very much convinced in a successful outcome. So he will add to his position, and when market performs something, I don't know, something very different from what he was expecting, when reality is not corresponding to his expectations, trader loses money more than he was expected. And I observe this pattern all the time analyzing traders' accounts. For example, I see that trader has average losses, average gains, and then in a trading log I see the loss that is 3 times greater than average loss. I ask a trader, what is the reason? Why did you lose, I don't know, $900? $900. Your average loss is $200. Why have you lost $900 in this trade? And he answers that he was very convinced in this trade, and he felt that he had to be aggressive. He had to be aggressive, right? And if you keep a journal of automatic thoughts, you might be one step ahead of yourself. All right, another example: generalization. When you think that this trade is going to be a loser, I would rather exit. You feel the emotional state of anxiety, fear, and you will start to defend your position. You will start to defend your position, and too many times you will exit your position at possibly the worst point. Of course, you will feel very, very much disappointment after that, because when you enter your position and get immediate loss, it is the one situation. But when you are entered a position, but you have cut your position, and later on your position, I don't know, went to the target, it is very frustrating. And I will say that even I with 11 years of experience still do the same mistakes from time to time. Well, I do many things right. I do more of what works, but sometimes I do the same mistake like beginner traders. And for example, my pattern that appears from time to time in my trading is defensive trading. When I'm inside of a drawdown, I start trading defensively. I will show you an example. The recent example from Euro versus American dollar that I was trading so far. Well, it was April 12th. Sorry, April 12th. I had a pretty good entry here. Because we have rotational center. We had rotational center 1.1405. And my first trade within this day was a long trade. I started to buy this market from the early hours of European session, from 1.1411. So it was pretty good point for entry. Market rallied higher. Then suddenly the big seller had stepped in, and I have reversed my position here. Well, guess what happened later? Market had rallied. I said to myself, okay, I am in a good position now, so market will go lower, because I was expecting to see lower targets to achieve. But later in the day, market started to trying to get back, And I have cut my position with a small profit as small as 10 pips. Guess what has happened later? My stop loss also was 20 pips or so. 20 pips or so. Not even, no, it's not. It was not 20. It was 12 or 15 pips. Well, it was pretty small stop loss here. It was pretty small stop loss. I have taken a small profit here, and at the one hand, everything is okay. But I have violated my plan because I started to trade defensively. Market has rallied lower at the very next day. I would have earned very nice profit-loss ratio in this trade, possibly 10 to 1. But I have missed this trade because of defensive trading. This is an example of how psychology really works, really influences our results. Well, I was analyzing my journal later on, and I have noticed that I started to know that market is very rotational. It was my words. Market is very rotational. Nothing will really happen in 3 or 4 days. Market will remain to be rotational. Possibly I will need to sit on my hands and not to trade, to wait until volatility comes back to the market. And guess what? Volatility came back to the market, but I was not in position. It was very frustrating, of course. But as for another example with Australian dollar, things turned differently because I was prepared for this volatility break. That happened yesterday. We had 2 days, really, we had 2 days of, guys, I guess that you see what I'm showing you. You see my screen? Alright, I hope that you see my screen. Alright, there were 2 days of very small volatility here. It was April 22nd and April 25th. And April 26th also was not very volatile day. 3 days of no action, right? 3 days of no action. And that's why I was expecting this volatility break, and I had given a trading suggestion in the Twitter, but I was not really trading this setup. I will not tell you that I have earned here, I don't know, 50 to 1 profit-loss ratio. No, I was not entering the market this day because I was out from the monitor. I was not following the markets due to some circumstances, let's say. But I was prepared to this situation, and I have given a suggestion in Twitter that market will possibly break to either direction, to the upside or to the downside. Well, it might even be the external day with great volatility, but it might be an external day. When you see sequences of 2 to 3 days of very low volatility, the day with a big volatility is followed. You never know whether it will be a trending day or an external day. What is external day? External day is a day that shows you higher highs and lower lows than the previous day. So the example was from the euro. I have shown it here so far. Notice that this day is external. It is really external. It was possible to earn trading in both directions. Well, how it relates to trading discipline? When you are, when you are not denying, when you are not anxious, when you are not trading defensively, you recognize right opportunities. Because when your mind is free, you recognize right opportunities, and you are able to recognize opportunities in the market. Because when we don't understand and we don't recognize what is happening with us, our perspective is very narrow. And it means that we will not recognize opportunity once it appears. All right. And to make our mind free, to free our mind, we have to catch this automatic behavior, automatic response, or automatic perception, catch once it appears. So the exercise is to keep a journal of automatic thoughts, or you can even create your own list of triggers, because every automatic response is state dependent. For example, when you are, I don't know, when you feel good, when you don't feel any pressure, when you have enough money, when you have good relationship in your family, you come to the market and you have a support, the feeling of support, I don't know, psychological support from your family, from your friends, and you feel yourself as a successful person. And if market does something, or for example, when you catch a stop, it will not affect your trading. But when you come to the market, when, for example, you are sleeping not very good, you have sleep deprivation, when you had some conflicts, some misunderstandings with your friends, with your family, I don't know. So you have come to the market and you try to trade in this state of mind. Of course, when market generates something frustrating, possibly you will start doing something automatically to defend your emotional state. You will start doing something automatically, right? To fight the market. And all we have to do is to know what emotional state are we experiencing now. It is very, very important. When you start your day, you might start your day with fixing your thoughts and feelings in a journal without any relationship to the market. You may just open your journal and write down all your feelings and emotions. What are you feeling right now? What are you thinking about right now? Well, it is called drill down, when you just free your mind in a free writing mode. You free your mind, and after that, you might notice that you don't want to get in a trade. Your approach to the market has become more adequate. You watch the market and you are not feeling any pressure. You don't want to get in a trade right now. You just observe, you just watch, and once setup appears in the market, you can trade upon this setup, but you don't want to jump in a trade right now. If you don't free your mind, if you come to the market and you have unconscious pressure, unconscious emotional pressure, you might experience the need to trade. You will possibly have the pressure to trade. And the first exercise is to make a drill down. And the second exercise is to keep a journal of automatic thoughts. Yes, the presentation will be provided to all participants of this webinar. You can write me an email. I will leave an email after the webinar ends. Well, you can ask me some questions, because we can go through the markets, watch what happens in the markets. For example, if you want my opinion on some situations, or you can ask questions about discipline. I suggest to come to the phase of questions. Well, if you have any tools or exercises for developing a discipline, you can share it in a chat. You have a question. All right. Please ask your question. You trade binary options and it becomes intense when candles move in a different direction in a given time frame. What do you mean? What becomes intense? What does become intense? Emotions, right? Candlesticks move in different direction in a given time frame. Do you feel that, or do you mean that market starts to move very quickly, or it rotates back and forth, it lacks destination? What do you mean by that? Market starts to move very quickly, right? And it pushes you to feel some kind of emotions, right? What emotions do you feel during that moment? Do you feel anxiety, fear, or fear, right? That is excellent. That is very popular pattern among traders. It is called fear of missing out. Fear of missing out. Possibly, I am suggesting. I don't know. It's my suggestion, because many traders feel this fear of missing out. Market goes back and forth with increased momentum. It's breaking out one level, then it gets back. It's breaking out another level. It's getting back, and traders think that, all right, now it will break. Right now it will break. I have to get inside a position. Now it will break. But I will tell you that it is very, very dangerous type of the market. You have to know how such market works. It is neutral or a normal day. It is called neutral or normal day. When markets does nothing, eventually it is a trap. Market goes back and forth. It generates many false breakouts, and for traders it is very popular day for over trading. Many traders, they start increasing their volume. They start increasing their number of positions in such days. And that's why you have to filter your trades in such day. Use your fear as a key, as a psychological key. If you experience this pressure, use this as a notification that, all right, I have to sit back, I have to relax, and I have to take a rest from the market. I have to just observe. I will not enter the market this time. My fear is my key. Your emotion here will be your personal filter to not get inside this market. What is the perfect countdown timer for trading options so that you can be in the money? Oh, I don't trade binary options. Maybe it's a question not for me. Alright guys, more questions please. If you have any questions, feel free to ask them here. Does anyone here experience anything similar? For example, when market breaks out from a range or market starts rallying, many traders feel uncomfortable. They don't want to trade this market. They feel uncomfortable. They feel that they would rather want to see average volatility. They don't trade the big days. And it is also the form of defensive trading. Well, it is not discipline. It is influence of emotional state of mind. Well, as for discipline, really, discipline consists of three parts. The first is risk control. The second is self-awareness, and the third is knowing what to do. Exact trading plan. How do you place a stop loss? How many pips from the entry point? It depends on the trading strategy. For example, if I trade the breakout momentum trade, like I was showing you previously, for euro versus American dollar, here it is a breakout momentum trade, right? And my stop is pretty tight here. I place this stop below the low of this small candlestick, below the low of a white candlestick that closes beyond the level. Okay, so it violates the level, it closes above the level, and I enter a position. I place the stop below this candlestick. Sometimes I use ATR. Sometimes I use ATR. When ATR is at its lowest values, for example 6 pips, I have to multiply it by 1.5 and get at least 9 or 10 pips for my stop loss. Well, for example, when markets breaks this level to the downside, and I enter a position, I also use ATR here. It is equal to 12 pips, so I multiply it by 1.5 and get 18 pips, or it is 18 pips or possibly 20 pips, close to that, 20 pips. So I enter a position and place my stop 20 pips above my entry point. But when I capture a pullback, my stop loss has to be more distant, because pullback trade is by definition a counter trend trade. Well, I will show you one example from yesterday. It is a pullback trade, yet the stop loss here was very small as well. Market has broken out a level 65.57. It is American dollar versus Russian ruble. It is a currency pair that I also follow among other currency pairs. And I had missed the first entry, but later on market has come back to this area. So I was able to enter this position and I place a stop right above. It was pretty small stop loss here. And my target was located here at 64.48, right? Why do I place such a target? Because I use here the symmetrical principle, the measured move. Here is a move. I use this volatility, the volatility of this move. I add this move to a rotational center, and I get my target. It is a measured move, right? And notice that market is not moving anywhere from this point. It has reached the target, and it's not moving down any longer. It doesn't mean that it cannot go down later, but for the present moment, it is a good exit point. How can trailing stop loss be effective? Well, trailing stop, I'm very careful with trailing stops, because when you place a tight trailing stop, it will be hit in many cases and you will get rid of the good position. So my approach to placing trailing stops is that first you have to see that the market has accepted levels that it has achieved. For example, I was trading gold here at April 19th. I was trading gold it was a breakout momentum trade that was executed early in the day. Market has rallied. Well, I know that I cannot place very tight trailing stop here. Yet I had placed a trailing stop based on double ATR on the 30-minute chart, and my trailing stop eventually was closed here. It was hit. Well, it is a compromise, right? It is a compromise. I cannot let the market take 50% of my paper profit. That's why I have to choose what trailing stop to place. But if I placed smaller trailing stop, well, in some cases, of course, I would preserve my position. But also in other cases, market would go to the target and let me earn more. How will we get the replay of this webinar? Well, this webinar, I guess, will be placed on YouTube Exynos channel, so you will be able to watch the recording of this webinar. Well, recording must be available, well, maybe in a few days. Also, if you need a presentation, you can write me an email directly to stanislav.bernehoff@exynos.com. I had placed it in a general chat. Any more questions? Well, while you are thinking on your questions, I will again pay you attention on very simple but not easy to execute principle. We have to break our automatic response. We have to develop a new habit of choosing our response, of stopping our automatic thoughts, automatic feelings, and to getting ourselves back to the resource and to choose our response. It is a habit, after all. It is not a characteristic for, I don't know, for 1% of the population. Now, it is a habit that can be developed over time. It is emotional intelligence, and it is self-awareness. It is a habit that can be developed over time. What lot size to use? I don't know. It depends on your risk. It depends on your risk management. For example, if you have, I don't know, stop loss equal to 20 pips and your loss in a single trade is equal to 1% on your account, so do the math. You have to calculate the size or the cost of 1 pip. You can use a calculator on Exness, for example. On Exness website, they have a calculator. You can choose a currency pair, choose a trading volume, and calculate its average cost of the tick. Please demonstrate how to place trailing stop loss. Alright. For example, the very simple principle is to use double ATR. It is a principle to place a trailing stop inside of a day. When market rallies and you are inside of your position, for example, ATR here is equal to 2.8 points. So you'll have to multiply it at least by 1.5 and get 4 or 4.5 points for your trailing stop. So when market achieves this level of 1256, you have to place your stop at, let me calculate one more time, 6, right? Around 6. 56. It is, your trailing stop will be equal to 6 points. Well, when you keep your position, when you hold your position overnight, of course, you cannot rely on a 30-minute ATR any longer. You will have to go on a daily chart, because when you hold your position overnight, you start accepting risks of higher time frames. For example, in this example from gold shows us that ATR here was already 15 points, right? 15 points. If you multiply this number or this value by 1.5, you get possibly 21, 22, and that is your trailing stop. If you want to hold this position, 22 points from extreme will be okay. 12.57 and 12.37, right? That should be your trailing stop. 37, right? But it doesn't mean that you will let the market breathe in such wide trading range. You have to have target. You have to have some target. But to reach this target, market, of course, would breathe, and it would correct. It will pull back, and you will have to rely on a daily ATR if you hold your position overnight. Thank you for this presentation. Alright, thank you, Dennis. I appreciate your coming and your attention also in this webinar. Yes, working on mistakes is really a habit that makes a trader. No one is perfect here. We come to the market without knowing really anything, right? We are we don't know anything. We are unconsciously incompetent. Then we slowly come to the phase of conscious incompetence, right? We understand that we don't know anything, but we're not so dumb to maybe to learn something. And after that, we come to conscious competence. It is pretty tough period, because we have to pay our attention to many things and to do it consciously. But we do one, two, three, four, five. I don't know. We do some certain steps, and we learn to make small amount of money in the market. And only after we learn to do those things, we come to the phase of inconscious competence. It is really the phase that makes professional trader. So guys, I suggest you to work in your trading to be consciously competent, at least consciously competent. Or if you are new to the market and if you think that you are already a good trader, possibly you are denying and you're consciously incompetent yet. And I guess that the earlier that you recognize that you don't know anything, the better will be for your trading. Alright guys, I appreciate you coming to this webinar. Now with that we are finishing this webinar. This webinar is prepared by Stanislav Bernhoff, which is me, an Exness company. I hope it was useful. I hope that you will capture important ideas, important thoughts and tools for your trading. I hope that you will develop your discipline and make profitable trade and become profitable traders. Thanks everybody. I will respond all emails in a few minutes after the webinar is finished.